You've seen if the market had to catch up to earnings, if the blue line has to catch the red line, then the earnings need to go, that green line is what the difference is. And that difference I've translated, actually Komal has translated through a mathematical formula into index numbers, which came to the 21,000 forecast for July 2010, based upon March 2010 results as the annual reports come out. Taking that 1 year forward, March 2011, a 26,000 index by July 2011 on March 2011 earnings. For March 2012 estimated earnings, the index could be 31,000 by, again, this is pure mathematical. We're not, I mean, stock markets do not go up in a straight line. Look at the squiggly blue line which shows the past indices. Earnings don't increase in a straight line. Look at the squiggly red line. But there's a direction to the earnings. And earnings ultimately will determine share prices. So, I may have sounded moronic for giving and idiotic and stuck my neck out for saying that this index could be 21,000 by July of 2010, a few weeks away, a month away. I'm sticking my neck out more and saying if the earnings maintained by all the analysts really pan out, then they should be talking about an index north of 30,000, 31,000. Again, this is not based upon a PE ratio being sensible. This is on a PE ratio of, I think, 21 or 22. So it's not a rational PE ratio. But when markets go up, I'm not asking you to buy the index at 31,000. I'm telling you to buy it now at 17,000 and begin to sell it as it heads to more irrational territory. Because when it gets towards 31,000, all the analysts, all the Wall Street firms, all the Dalal Street firms, all the NSE, BSE brokers will be rationalizing why 31,000 is actually too conservative and maybe 40,000 makes sense. Who knows? But at that point in time, it is price action distorting and value is no longer there. So the argument is not that this is the fair value of the index. The argument is the price of the market today reflected by the BSE 13 index is 16, 17,000, bouncing up and down. It's a great opportunity to buy because someone is going to be willing to pay a lot more for it in future, not because of a bubble, but because the earnings are actually growing. And then they'll be willing to pay more for those earnings as they begin to forecast 2013 and 2014 and for the next 10 years. And that's when you begin to sell and wait patiently. So I am defending my 21,000 call. Could happen in the next month or two, who knows. Still have, technically we've got till July 3-1. Let's see what happens. But there is a strong economy, which is shown in better revenues for companies and also better earnings. The US recession, which may happen again in terms of the slowdown and what they call the double dip, and the hard landing of the pigs has certainly scared speculators, and short-term money has gone out, as we saw a sale in the month of May by the foreign investors, $2 billion. Long-term investors move very slowly, but that money is coming and will come more. When the risk takers rush back in, those share prices will head back north. Some of good companies, some of useless companies. But remember this, you don't buy shares when others are buying. You should be buying early and waiting patiently. And you want to sell to those who buy later.